If you had to generate $10,000 a month from property, how exactly would you do it? Most people have no idea. They get told to buy 10 properties in 10 years or buy properties with a better yield. But no one hands them a roadmap to actually create consistent income. So that's what we're doing today. Over the past 9 years, I've helped hundreds of investors around Australia answer this exact question with a 10-step approach that prioritizes this end goal from the start. So in this video, I'll be breaking down the exact 10-step roadmap you need to achieve $10,000 a month, why you don't need as many properties as most people tell you, and most importantly, the 2 silent traps I see shared online that seem helpful, but falling for even one of them could quietly kill your chances of ever hitting $10,000 a month. Right now, I'm seeing people chase after property in places like Broken Hill or Kalgoorlie because of their high yields. Let me tell you why this is a recipe for disaster. If you're looking for income of $10,000 per month from properties, you're looking to have a bunch of properties that will pay you an income consistently for the rest of your life, which will hopefully be not just multiple years, but multiple decades. Now, let's take a place like Kalgoorlie. No disrespect to the people who live there, but there isn't much going on in Kalgoorlie, except a lot of large holes in the ground where big companies are mining. Now, what happens when those massive mines end up empty, or the mining industry has a downturn, or China or America decide to do something that affects the mining industry? Boom. Overnight, those major projects can be shut down or put on hold indefinitely. Jobs are lost, people leave the area, and what happens? There's nobody there to rent your property. And if you have a mortgage, instead of the property paying you, you'll now need to pay the property. And you'll struggle to sell the property for what you even probably paid for it, because nobody will want to invest or live in Kalgoorlie if that happens. And we saw this happen in 2012, 2013, after the last mining boom, when prices dropped 50 to 60% overnight. And it will almost certainly happen again. So step 1 in this 10-step system, stop chasing income-producing properties. You're taking a huge risk. You're putting your family's financial future on the line. I just wouldn't do it. So if positive cash flow properties in places like Kalgoorlie are not the answer, what do? Well, to answer that question brings us to step 2, which is to understand the maths. $10,000 a month equals $120,000 per year. Let's stick to a very conservative 5% rental return on your property portfolio. Now, you might immediately say, but Nero, you can't get a 5% return on property in good locations today. And you're right. With property prices where they are relative to rents, you won't get a 5% rental return in almost any good area today. But you'll almost certainly get to a 5% rental return eventually. I'll explain that one in one of the later steps, so stick with me here. For now, let's say you've got your property portfolio to where you are getting a 5% return. Remember, we're looking for $10,000 a month or $120,000 per year. So if you want $120,000 per year, we need a property portfolio of $2.4 million fully paid off. And that's the key part. There's no debt on this portfolio. If you have a $2.4 million property portfolio with no debt paying you 5% rent, there's your $120,000 per year or $10,000 per month. Therefore, although your goal is $10,000 per month, that's actually the result. Your goal, your focus should be to build a property portfolio worth $2.4 million or more that is fully paid off. That is the actual goal you should be aiming for. And when you realize that, it changes your entire property investing strategy. You stop chasing income producing properties. You stop chasing properties that are cheap. You even stop looking at properties that give you good depreciation or other such perks. Instead, you start looking for the right strategy to get to a $2.4 million property portfolio fully paid off that gives you a 5% or higher rental return. That is now your real goal. And just before I continue, if you want these steps explained in even more detail, you can download totally for free my step-by-step guide in the description below that shows you exactly how I and my clients have built or in the process of building a property portfolio that pays you a passive income every month. So now that we understand what we're really aiming for, where do we start? Well, that's the next step in the process, and it's this: buy the best property for capital growth that you can afford. That's right. We begin a journey to 10K a month cash flow by focusing on capital growth. Now, why do we focus on capital growth? The answer to that will become pretty clear shortly. It also means that the property you're going to buy is going to have a negative cash flow. Yes, you want to end up with a goal of your portfolio paying you, but you start by getting properties that you need to fund, at least initially. Now, let's assume you buy a property for $700,000. Your loan will be 80% of this, or $560,000. And let's assume that in 3 years' time, your $700,000 property is now worth $950,000. Now, if this seems unrealistic, these sorts of results are actually very common for our clients. Showing you how to find these areas, well, that's out of scope for this episode, but the step-by-step guide I mentioned earlier that you get in the description below, that'll also walk you through how you can find those areas that are expected to outperform in the coming few years. It's definitely very, very doable. Now, back to our $700,000 property that has risen in value to $950,000. What do we do next? You borrow a portion of the uplift of your property, known as equity, and use it for the deposit and purchase costs to buy another property, let's say for $800,000 this time. You'll of course need a loan on the second property as well, and that's something to keep in mind. In the initial stages of this roadmap I'm giving you, you'll actually be increasing the debt on your portfolio. Yes, your end goal is to be debt-free on a $2.4 million property portfolio in this scenario, but initially you're going to increase your amount of debt as much as you can. Why so many people get this roadmap to 10K in 10 steps wrong is they think that since they want to be debt-free, they should look at cheaper properties and pay off the debt more quickly. Since they want passive income, they should focus on positive cash flow from the beginning. Yet hopefully you're starting to see this roadmap is actually quite counterintuitive. You want to be debt-free, but you start by increasing your debt. You want properties to pay you, but you start by having properties that you need to fund. I promise you though, this will all come together very soon. Let's keep going. From here, you just repeat the process as often as you possibly can. Buy a property in a high growth location, have it rise in value, take out equity, buy again, and just keep going. Now, you might not need to wait as long for, say, property number 3 like you did for property number 2. Why? Because when you're looking to buy property number 3, you already have 2 properties in the market that are rising in value, not just one. So your equity position will increase faster, allowing you to take out funds for the deposit and purchase costs on your next property. And potentially you can buy property number 4 faster still because you'll have 3 properties in the market. It becomes like an exponential curve or an upward sloping curve as your time to buy between each property keeps getting shorter and shorter. Of course, you do need to consider your personal circumstances here, like cash flow and borrowing capacity with all of this. That's why I don't like a lot of this information floating around online about how to buy one property every year for, say, the next 10 years. If you do what I'm showing you correctly, you don't need to stress out and try to buy one property every year. As you'll see in a moment, you can still buy one property just every 3 to 4 years on average and still end up hitting your goals more quickly than you probably expect. But the question becomes, how do you handle the negative cash flow of the property portfolio? Let me explain. At the moment, with where interest rates are at as I record this video, let's assume your first property might cost you around, say, $2,000 per month. Now, while you might be able to afford that on one property, buying multiple properties that cost you $2,000 per month, well, that isn't something most people can handle. So what do? This is another reason why you need to allow time between each property purchase. Why? Because over time, if you buy in the types of areas I show you in my step-by-step guide, You'll get properties that don't just rise in value, you'll get properties where the rents rise as well. So over time, that cash flow on the property, how much it takes out of your pocket, it will actually reduce. And when it gets to a level where you're comfortable and you've got equity, you can then go and buy your next investment property. You could theoretically even wait until that first property that's initially costing you about $2,000 per month, it gets down to costing you nothing per month. And then you go and buy a second property that again costs you, say, $2,000 per month. And now you've got two properties that cost you the same as one. That's why I can't promise you how long it's going to take you to get to 10K per month. It depends on your own personal circumstances. However, if you are wanting to get to 10K per month from a property portfolio faster, then here's why right now as I record this episode, it could be an amazing time to kickstart your investing journey so you can get ahead faster. Interest rates are about to fall. Now, when that happens, everyone knows that prices will rise substantially. So yes, you want to get into the market so you don't miss out on the price rise. But here's another benefit that most people fail to consider. When interest rates fall and you're already in the market, assuming you've kept your interest rate variable, your mortgage payments fall. That means that the amount of money your property costs you reduces. You might very quickly find that the property that cost you, say, $2,000 per month to hold, which you could afford, now costs you $1,000 per month to hold. And what does that mean? You can now get a second property that also costs you $1,000 per month to hold, again, because interest rates have fallen. You now have two properties that cost you $1,000 per month each to hold, or $2,000 per month in total. And again, you've ended up with two properties that cost you the same as one. Okay, so let's go back to our hypothetical scenario where you bought a property for $700,000, it rose in value to $950,000 3 years later, and you used the equity and another loan to buy a second property for $800,000. You now rinse and repeat this scenario. Say you buy a third property 3 years later, and maybe a fourth property 3 years after that. So you end up now with 4 properties in a 10-year period. Here's how the numbers work out. Property number 1 is worth $1.5 million. The debt, $760,000. Property 2 is also worth $1.5 million. The debt, $852,500. Property 3, worth now $1.15 million. The debt, $905,000. Property 4, that's worth $900,000 as you just bought it. The debt, $720,000. So your total portfolio at the 10-year mark is $5.05 million. Your debt, though, is $3,237,500. Now, that might seem like an eye-watering amount of debt to take on, but remember, you've got tenants helping you pay for this. And like I showed you earlier, you've done this in a way where cash flow isn't really troubling you. Now, if you're not sure how I got these numbers, don't worry. The key here is to understand that you've got 4 properties in this scenario. They've all risen in value, except for the last one because you've just bought it, and you've got debt against all of them. That's it. Now, what do we do next? Nothing. Absolutely nothing. We just wait and let time work in our favor. Let's say we decide to wait another 5 years. So that's 5 years of doing absolutely nothing. And let's assume our portfolio has been rising on average by 7% per annum. Nothing flash at this stage. Yes, at least property number 4 would probably have outperformed that because it's your newest purchase, but let's just ignore that for now, trying to be conservative here. So 7% per annum for 5 years. Well, our portfolio has gone from $5.05 million to $7.08 million, just using some round numbers. But our debt is still the same as it was previously at $3,237,500. So when we do the maths and we subtract the debt from our current property portfolio, we end up with a net worth of $3,852,500. Here's how each property looks. Property 1 is now worth $2.1 million. The debt, $760,000. Property 2, also worth $2.1 million. Debt, $852,500. Property number 3 is worth $1.5 million. The debt, $905,000. Property number 4 is now worth $1.26 million. The debt, $720,000. So that's how each property looks. In this situation, what would happen if we sold properties number 2 and 3? Well, first of all, the debts against them gone completely and immediately. That's why we don't try to pay off these investment properties while we hold them. We're going to get rid of the debt when we sell anyway. So property number 2 plus property number 3 gives us a total value of $3.6 million. Their total debt is $1,757,500. That means after selling, we'll end up with $1,842,500. Now I know that's a lot of numbers here, so stick with me. What's the remaining debt on properties number 1 and 4 that we've chosen to hold? In total, $1,480,000. But we've got $1,842,500 from the sale of properties 2 and 3. Yes, you'll need to pay some capital gains tax, but this should still leave us with enough to extinguish the debt on properties 1 and 4. You, of course, would have figured this out in advance before you sold, and I'll share with you in a moment how you would have done that. But in this scenario, we now end up with properties 1 and 4 totally paid off. Remember, property 1 is worth $2.1 million, property 4, $1.26 million. So that means you have a property portfolio worth $3.36 million in this example, even if this portfolio only gave you a 4% rental return, not the 5% that we expected. That would give you a passive income of $134,400 per year, which is more than the $120,000 per year or $10,000 per month that we were after. Now that extra income will help you with some of the holding costs of the property, because even though you don't have a mortgage anymore, so you don't have to worry about interest payments, you still have to pay for things like rates, insurance, and some maintenance. Now, as you can see, this can get complicated. So disclaimer, I do not recommend you try to do this on your own. This can go wrong in so many ways. Perhaps you're really good with the strategy and with numbers, but you're not sure how to do the research and the property price negotiation. And if you buy the wrong property in the wrong area, your plans won't reach fruition. Or maybe you're really good at property research and negotiation, but if you don't get the strategy bit right, you'd end up going down the wrong path. Or you could end up selling the properties too early because you didn't do the numbers correctly, and you end up not selling for enough, and you still have debt on your remaining properties, right? So yes, this is a plan that can work, but I urge you to build the right team around you. This is what we do for our clients at Investment Rise, because as you saw, even in this hypothetical scenario, it still took us 15 years to get there, right? This is not a get-rich-quick scheme, but it is a get-rich-safe scheme as long as you work with the right people who you can build a long-term relationship with. So now you've got the full roadmap to build $10,000 a month from property. But here's the thing, earning income and earning passive income aren't always the same. So although a lot of internet gurus love to sell the dream of passive income, it's not as easy as you think. It is possible, but it needs to happen in 2 distinct phases. And if you want to find out exactly how this works, you can check out this video here.